You've been running the Sunday night math on the mortgage line. Open the insurance bill. That's the number that moved 5 years running. Your mortgage is locked. 30 years, same payment, frozen the day you signed. The insurance line underneath it is not frozen. It has climbed every single year. Here's the one that lands. Since 2021, home insurance has risen 46%, nearly 3 times the rate of inflation. Same house, same coverage. The typical homeowner now pays about $900 more a year than in 2021 for the exact same policy. That's a phone you never bought every year. I'm dropping these daily right now. Subscribe, and tomorrow's math finds you. Today we climb the insurance bill, tier by tier, until you see where your lever is. Start at the floor, the national baseline, because every scary headline you've seen is built on this one figure. By the end of 2026, the average annual home insurance premium in America reaches $3,057. Hold that number. We're going to climb it tier by tier. Walk it backward, one step first. The end of 2025 sat at $2,948. The climb from there to $3,057 is the quiet 4% everyone keeps quoting as if 4% is nothing. On a line you already pay, it isn't nothing, but that 4% is the gentle version, the part they print in the headline. Rewind one more year, getting to 2025, rates rose 12% across the country in a single 12-month stretch. The slope is far steeper looking back than the projection looking forward. And here's the part. The smooth projection quietly hides from you. This is not one unlucky year you can wait out. It is the 5th straight year of increases with not a single year falling in between. Up, 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 and projected up again. A 5-year streak, not a one-time spike. Per Insurify's 2026 report titled Insuring the American Homeowner, $3,057, up 4%, stacked on top of 4 consecutive years of rising premiums. That source is the entire foundation of today's video, and it's sitting in the description with a live link. 3 hours with the filings and a calculator. Every number's in the description. Tap the timestamp if you don't believe one of them. Now hold those 2 numbers up side by side. Your mortgage payment, fixed since the day you signed, immune to every year that's passed. Your insurance premium, up 46% since 2021. Climbing while you weren't watching. One is a statue, the other is a tide. Here's where the bank's math and your math split apart. The bank stops at principal and interest. The part it gets paid on, your math includes the insurance line that's risen nearly 3 times faster than inflation. The bank ran exactly one question before it handed you the keys. Can this household keep paying the loan back? That's the whole test. Principal, interest, a debt-to-income box checked off, application approved, money wired. The insurance number was just an escrow line item. It folded into the monthly draft and forgot about. Your question is the one the bank never bothered to ask because the bank doesn't have to live in the house. Not can I keep paying the loan? Can I keep paying everything wrapped around the loan? Because the loan held perfectly still and everything around it climbed year after year. Picture 2 households on the same street, same income, same 30-year mortgage signed the same month. Household 1 budgeted carefully to the loan payment. Household 2 budgeted to the whole bill, insurance and all. 4 years later, they are not living on the same planet, and only one of them understands why. Household 1 watched the escrow account come up short every single spring and never understood why the mortgage company kept quietly raising the monthly draft. They blamed the bank, they blamed taxes. The loan itself never changed by $1. The insurance premium feeding that escrow account did every year. Household 2 saw the same $900 climb arrive and treated it as a moving line, not a frozen one. They shopped 3 carriers, raised the deductible, checked the rebuild number, and kept the lever in their own hand instead of the insurer's. Same income, same house, completely different math by year's end. This is the quiet mechanism running under the whole story. The payment that wakes you up at 2 in the morning is not the mortgage. The mortgage is the one number on your entire statement that genuinely cannot surprise you anymore. You locked it. It kept its word. It's done changing. The surprise lives in the line you quietly stopped reading years ago. You audited that interest rate for weeks before you signed, refreshing rate sites, agonizing over 1/8 of a point. You have not opened the insurance declarations page since closing day. That blind spot is exactly where the 46% went. And here's why a $900 climb actually bites so hard. Instead of being something you can just absorb, housing is already the single biggest slice of the American household budget. Not a slice, The slice, about a third of every dollar a household spends in a year, goes to keeping a roof overhead. Per the Bureau of Labor Statistics Consumer Expenditure Survey for 2024, the average household spent $26,266 on housing out of $78,535 total spent that year. That's federal data, pulled straight from the source, no estimate. So when a line living inside that biggest slice climbs 3 times faster than your paycheck does, you don't feel it in the insurance line. You feel it everywhere else. The insurance creep doesn't stay politely in its own column. It eats the grocery line, the gas line, the kids' activities line, the small cushion you were trying to build. The dollars have to come from somewhere, and they always come from the part of the budget you least wanted to touch. Don't take my word for the federal piece. Open the Bureau of Labor Statistics link under the video. I'm running the exact same query you can run from your kitchen table. But now I have to stop and do the honest thing, because this is the exact spot where most of the scary versions of this story quietly lie to you. That $3,000 average, that 4%, is a national number. It is the calm middle of the country. It is not what's happening to everyone, and pretending it is would make me one of them. So before we climb the scary tiers, plant that flag. The floor is calm, the gradient is steep, and which one you live on changes everything. The national average is the still center of a wildly uneven map. Behind that gentle 4% sit 6 states where rates jumped more than 20% in a single year. Entire states getting hit while the country's average barely moved. The fire is real, but the fire is regional, not everywhere. Per Insurify's state-by-state breakdown, Minnesota up 34% in 1 year, Colorado up 33%, Nebraska up 25%, Oklahoma up 24%, Iowa up 28%, South Carolina up 26 states, each absorbing in a single year what the national average took 5 years to do. Quick pause. Drop the number you've been afraid to run, your own premium, your own zip code. Most upvoted comment becomes tomorrow's video. Subscribe daily right now so it lands the moment you wake up. And then there's the outlier that makes the national average look like a rounding error. Florida's average premium sits near $8,292, roughly 3 times the national number for the same basic product. Same coverage, same kind of house, different zip code, genuinely different universe. One number I have to keep honest with you, because I'd want it kept honest with me. Those state jumps are, quote, platform figures, not the approved filings sitting at the state insurance department. The filed rates run somewhat lower, but the direction is identical everywhere. The risk is high, up fast and not slowing.
So why is the fire regional instead of even? Because behind every rising premium sits a thing carriers almost never say out loud. They would honestly rather not insure you at all if the math scares them. And where the risk is highest, they have stopped pretending and started acting on it.
In California, the proof hides inside the last resort pool, the state-backed plan you only land on when no private company will write you at any price. That plan, the FAIR plan, grew to roughly 573,000 policies by March of 2025. That is up 139% since September of 2021, and the exposure behind it, the dollars on the line if those homes burn, climbed 424% to $603 billion. That is not a healthy market. That is an evacuation with paperwork. When the plan of last resort triples in a few years, it means the private carriers walked out the front door first and left people with nowhere else to go. State Farm, Allstate, and others stopped writing new homeowner policies in California entirely. The pool of last resort quietly became the pool of only resort. And to be clear, this is not just one state's run of bad luck you can write off as California being California. The federal data shows exactly where the pain concentrates across the country, and it lines up cleanly with one variable and one variable only: risk. Per the U.S. Senate Budget Committee's non-renewal dataset covering 65% of the market and 249 million policies, 48 of the top 50 counties for rising non-renewals were coastal or wildfire zones, 48 out of 50 sitting right on the risk. 48 of 50. That is not a coincidence you can hand-wave away. That is a map of the crisis drawn by the insurers themselves. The insurance creep is not a flat tax landing on every roof in America equally. It's a flood, and it rises fastest exactly where the ground is already wet. The lesson of that map is simple, and it matters to you specifically. If your home sits in a wildfire corridor or on a hurricane coast, you're standing in the fire, and your playbook is different and harder. If you're not, and statistically most of you watching are not, the fire has not reached your street yet. That distinction is the whole difference between panic and a plan. And it's the reason the next part of this video is actually good news for most of you, which is the whole reason panic is the wrong response for most people watching this. The headline screams the sky is falling on every homeowner in America. The actual data says the sky is falling hard on specific addresses, and yours might just be getting a light drizzle you can still manage. So let's talk about the people standing closest to the edge of this. The ones who bought a home in the last year, stretched to get in, and are now watching this insurance number move underneath them for the very first time, with no equity cushion built up yet to absorb it. Nearly half of recent homebuyers, 47% of them, say that if their premium rises again over the next year, they will have real difficulty affording their mortgage. Read that carefully. It's not a prediction of mass foreclosure. It is a self-report of how close to the line these households already feel. Per the Zebra's 2026 State of Insurance Report, and the honest framing matters here, that 47% is specifically recent buyers, the ones who stretched hardest to get in the door, telling you in their own words how tight the budget already is. It's their perception of their own kitchen table. And 3 out of 4 of those recent buyers say the insurance premium plays a significant part in their overall housing budget. Read that one twice. Not the mortgage payment, the insurance line. It is now a number people actively feel and worry about when they do the math on their own home. And that is the whole inversion at the heart of this story. For decades, the mortgage was the monster in the closet, and the insurance premium, a sleepy footnote in the escrow account. Now the footnote keeps recent buyers awake, and the mortgage is the one part of the bill that finally stopped changing.
Got a different number sitting on your own spreadsheet, a premium that moved more or less than the ones I just gave you? Drop it in the comments below. I read every one, and the gaps between what I've got and what you're living are exactly where the next video comes from.
Now here's the part the panic version never gets to, because panic by definition has no lever to pull. If you're not in a disaster zone and the federal map says most of you simply aren't, you're not stuck and you're not helpless. You have moves the bill-blind household never makes. Lever 1, shop it hard. The premium quietly climbing on autopay every year is the premium nobody has bid against in years. Same house, same coverage, pull 3 real quotes. The spread between the cheapest carrier and the priciest for identical coverage is routinely hundreds of dollars a year, sitting there for the taking. Lever 2, raise the deductible. Moving from a $500 deductible up to $1,000 or $2,500 drops your annual premium noticeably. And the higher deductible only ever costs you in a year you file a claim, which, for most homeowners, doesn't happen. Lever 3, bundle the policies and verify the rebuild number. Carriers hand out a real discount when the auto policy rides along with the home policy, and a surprising number of homeowners pay to insure a rebuild cost far higher than the house would cost to rebuild today. You insure an inflated number. And here's the timing piece that turns all 3 of these levers from someday optional into do it now urgent. The window to shop your policy only stays open as long as private carriers are still writing your zip code at all. In the disaster states, that window is actively closing as we speak. Everywhere else, it is open today, and only today is guaranteed. The carrier still bidding for your business this morning is not promising to bid for it next spring. The move that costs you nothing now can quietly become impossible later. And this is the bank versus you math finally closing the loop. The bank only ever cared about one thing: whether you default on the loan it gets paid on. Your math starts one question earlier: can I keep the whole bill from eating the rest of my life? The lever answers that. 3 numbers to carry out the door with you. 1, 46%, the 5-year climb on the very line you stopped reading after closing day. 2, about $900 a year more than 2021 for the exact same coverage you already had. 3, 4% is the national story, but the real fire is regional, and you need to know which side of the map you live on. Carry those 3, and you already understand more than the headline ever told you. If you fix exactly one thing this week, fix the line you've been ignoring for years. Pull the declarations page out of the drawer. Read what you're actually insured for and at what rebuild cost. Then get 3 real quotes before the autopay renews. That's the whole defense, and it cost you 1 afternoon. Because the trap here was never actually the mortgage. The mortgage did precisely what it promised you on day 1. It held perfectly still for 30 years. The real trap was the quiet, comfortable assumption that everything sitting around that mortgage would politely hold still too. It didn't, and it won't. Remember exactly where we started, the Sunday night math. The mortgage line you keep staring at and re-staring at in bed. The number that actually moved on you was sitting 1 line below it the entire time, climbing year after year quietly, while you weren't looking at it. If this helped, like it, comment your premium and your zip. Subscribe daily right now. Tomorrow's math lands the moment you wake up. Your mortgage is a promise that kept its word. The line beneath it made no promise at all, and that's the one you have to watch. Read the line you stopped reading. Math doesn't negotiate. Don't try.